Well, the Westpac Red Book has just been released and again provides some interesting insights into Australia's domestic economy. Recall that this report goes through the Australian consumer, particularly the Consumer Sentiment Survey responses with a fine-tooth comb, looking beyond the overarching themes into some of the subplots from the survey data. We also draw quite heavily on Westpac's customer data and the insights they can provide. The Westpac card tracker and consumer panel now has information up to September and even a little bit more recent. So what does it all show? Well, if you recall, the recent surveys for consumer sentiment are showing some promising signs of improvement. We've gone from deeply pessimistic to just pessimistic. The improvement is mainly keyed off in the last couple of months, is mainly keyed off a sharp easing and rate rise fears, with specific questions about where consumers expect mortgage interest rates to be in the next 12 months have calmed down significantly over the last couple of months. They're broadly consistent now with 2 or 3 rate cuts over the next year compared to some fears of further hikes 3 months ago. Aside from that, though, we are also seeing some improvements around family finances. In fact, compared to 3 months ago, sentiment overall is up just over 8%, but assessments of family finances compared to a year ago have improved by more than double that, over 16%. They were coming from a much weaker starting point, so we're still quite downbeat around where finances are at, but that's a fairly promising sign of improvement. Now, the drivers here are more varied. On the first instance, policy has been unchanged now for the best part of 12 months around the RBA, and so the mortgage belt is not being hit by rate rises in the way it was 6 to 12 months ago. At the same time, of course, we've had tax cuts since mid-year, and that shows through particularly for responses amongst middle income consumers, where assessments of family finances have shown a more pronounced improvement. As I said, the mortgage belt has also been a big improver, and that's likely to reflect in some part the improvement in dwelling prices over the last few months. And then there's another sort of subplot in some segments that may have had an impact. Fuel prices, average pump prices in Australia have moved significantly lower over the last 3 or 4 months. So some promising signs around consumer assessments of family finances. Around that forward view, if we look across the 100 subgroups that we track as part of the consumer survey, around 90 out of the 100 have seen an improvement over the last 3 months, so the improvement has been broadly based. Where there have been some exceptions, though, I think that's quite interesting. Amongst renters, the expectations for the economy hasn't shown an improvement. Consumers in Victoria, similarly, haven't seen the same sort of lift in sentiment. It looks to be a state subplot around the Victorian economy that's restraining things there. And in terms of where people are employed, those that are employed in the health sector, in the tech sector and the manufacturing sector haven't participated in this rally in sentiment in the way others have. So there also look to be some sector-specific issues around health, probably relating to uncertainty around government funding. The tech sector, as we know, has been going through a global round of layoffs that's impacting in that space, and manufacturing often sees things struggle when we're seeing cost increases. So there are some significant subplots out of the consumer sentiment survey, but the overarching story is still reasonably positive. We've come out of this very bleak period of the last 2.5 years where confidence has been very downbeat. We're now just pessimistic. Sentiment overall is about 1 standard deviation below its long-run average. So we're still in pessimistic territory, but starting to move in the right direction. And I think if we look forward, if some of those expectations around interest rates in particular start to improve, then that we can sort of presumably build on that momentum. What about the Westpac data? Well, on that front, it's still looking pretty soft. The consumer card tracker and consumer panel data for the month of up to the September month shows that tax cuts have provided some impetus, but so far most consumers look to be sitting on that increased extra income, about $1 in $6 being spent rather than what you might expect going in of maybe 50-50 spending of additional cash. The patterns across subgroups reinforce some of that restraint. So the mortgage belt in particular looks to have been quite restrained with directing those tax cut benefits towards repaying debt or accruing savings rather than spending. And we look across different income bands. There is a little bit more spending of tax cut stimulus measures happening in the lower income ranges, as you'd expect, but overall it's pretty muted compared to previous rounds of fiscal stimulus. And I think that's very much consistent with that picture from consumer sentiment. Yes, it's improved over the last 3 months, but most Australians are still very wary about the outlook. Still contending with significant financial pressures. Many will be looking to use tax cuts as an opportunity to rebuild depleted reserves rather than go on a spending spree. So all up, the wash up is starting to look a little bit more promising, but it still looks like it's going to be quite slow going for the consumer in terms of their spending patterns heading into this Christmas New Year period. We do expect to see some further improvements in the picture, the broader landscape for consumers, particularly if we see an expected slowing in inflation domestically. I think that clears the way for a bit more confidence that some monetary policy relief will be available down the track. But for now, we're going to have to continue to wait to see those things come to pass, and consumer sentiment hopefully will improve further from here. Perhaps next year will be the year that we see more meaningful lift in spending.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.